Okay, hello. Good to have you all here. I've just turned on my microphone, so if you can hear me, please do let me know. I will. Always good to get some feedback. So good to see so many of you. We still got people coming in, and I can see people coming in from Dorset, Cambridgeshire, few people I know, and please do let me know you can hear me, and then I'll crack on because I know it's 6 p.m. Oh, that's fantastic. Thanks for letting me know. Mark Carter, lovely to see you here. And so many people here. It's great. And it's now June. Everybody's hopefully been having a better time in the market recently. Certainly we'll be covering some of that ground in this webinar. And I'm going to crack straight on. This will be about an hour presentation. And I will be sharing with you a few resources. There'll be some good resources at the end. I've got Lawrence here who's helping as well today. So please, if you ask any questions, Lawrence is there, and hopefully he can answer any issues in line. And he's also got a chat to me if there's any, if I need to pull a ripcord. Right, I'm going to crack straight on. So this is a bit of a combined webinar. We sort of framed it as how to pick the best value stocks for the UK market recovery. It's also about the stock ranks. And we've got quite a lot of materials to share, and I'm quite excited about some of them. That's something I've been putting quite a lot of work into lately. So, right, first of all, this isn't investment advice. There is lots of backwards looking sort of performance data and things, and the future may not be like the past. Past performance not predictive of future performance, etc. We aren't a financial advisor. This is very educational only. Everybody here needs to be a self-directed investor, and please do ask an advisor if you're in any uncertainty. So after that, we'll crack on. So this is me. I'm Ed Croft. I'm your host today. I'm the co-founder and CEO at Stockopedia.com. I used to be a wealth manager. I think many of you here will know me quite well by now, and I'll have met many of you at events around the private investor community. So thank you all for putting your trust in us at Stockopedia.com, which we've been growing ever since we launched it as a subscription service back in 2012. And, you know, we have got more than 10,000 subscribers, and it's brilliant to have so many of you here today. We really enjoy this work. It's been very challenging the last couple of years with the markets being difficult for UK investors, but thank you all for your trust in us, and we go from strength to strength and lots of good things to come. So anyway, what are we going to be doing today? Now, this is 1 hour invested in yourself. And if you've been a long time subscriber, some of these concepts you'll already know, but I always think it's funny how we forget things, and actually just reminding ourselves of sort of timeless principles is always very, very valuable. And okay, so on the agenda today, the UK stock market, it is, in my belief, undervalued, underloved, and it's now breaking out. I'm going to cover a little bit of the UK stock market from my perspective before I go on to having a think about how we can use some of our services to help find great UK value stocks for the recovery. I'm going to talk a little bit about common traps people get into, story stocks, broker recommendations, and often there's some of the pain that happens from doing your investing that way. I'm going to cover our stock selection framework, kind of our investment philosophy at Stockopedia. It's a stock selection framework that really works about 3 key drivers of market outperformance: quality, value, momentum, the core components of the stock ranks. And I'll share with you some new key statistics that have fallen out of the stock ranks and all the data we've saved over 10 years of publishing them. I also then will go into some case studies. I want to share some stocks and portfolios, one model portfolio. I'm going to share a personal portfolio, or at least the performance of it, and also want to share how Paul and Graham, our small cap analysts, watch lists have been doing year to date, because that's another kind of angle on these things. And then I'm going to give you a quick demo of how I use the site to go and find different types of shares. And then we've got this top 10 stocks, which is the highest QVM stocks. If you don't know what QVM means, you'll know soon, across 10 sectors. And excitingly, we have this bonus ebook. Now, I have, I think here, yes, been pulling together a huge amount of resources into this ebook called Investing with the Stock Ranks. There might be some of you on this call who read this as a beta reader 12 months ago. Well, we did a huge amount of work on the data since, and I finally managed to ship this with a lot of help from the team, and it looks really snazzy. There is about 165 pages here, so there's a lot to dig into, and it compiles many of the kind of best ideas, insights, statistics, guides, and more into one accessible publication. So we will be sharing that in due course if you stick around in the webinar. So excited to get that out today and very keen on feedback. This will be first edition, and we can follow up if there are errata or anything in due course. So great to hear. Okay, and then we'll do some Q&A at the end, and then we can all get supper. Right. Thank you, Jason. Okay, so first of all, on the UK stock market, where does the recovery go now? So I've been thinking about this, and if you know me, I would classify myself as a factor investor, a data-driven investor, and a trend follower. And really all these things are about being guided by the statistics in the market to act, okay? And I'm a big believer in that, in using the observation of what is true to act. And if you were paying attention and logging into the site towards the end of last year, well, you'll have known that I track the AIM all share, and many people hate the AIM market. And I certainly, look, there are IHT benefits and so on, but there was a 2-year bear market from September 21 to, well, actually October, November 2023. And the reason I like tracking the AIM all share index is because it's a very good barometer of sentiment. And the eternal outflows in funds in small cap funds is a great barometer of animal spirits in private investors. And two things happened towards the end of the year. And I have studied a lot of technical analysis in my time. And I published this piece saying that the AIM market was at its most oversold since the global financial crisis. According to the monthly RSI indicator, there were only 2 times in the last 30 years that it had been as oversold at that exact moment I point to on the chart, which very closely within about 10 days marked the bottom. And sometimes these things at real extremes can be quite valuable. And I followed it up. You'll see this red squiggly line, which is the 120-day moving average. Followed it up with a timing update to say the AIM index has signaled a new uptrend, and it's been above that ever since. Now, the trend may reverse and fall back down again. Of course it might. But it's quite interesting tracking the AIM index because it really is a dismal index. In almost 30 years, the index has gone up and down, up and down, up and down, and gone nowhere. In fact, it's sort of lost value over that time. But if you were to only ever buy when it's above its 120-day moving average, you can turn this dismal going nowhere story into a return that looks like this at 15% annualized. And the power of there is that the AIM index trends, and it trends very, very interestingly, very, very well. And so when this chart is going sideways, that means it's in a downtrend and you'd have been out of the market. And now it's triggered a new uptrend, and there was one failed uptrend in January last year. And my point here about the UK market is that markets go in cycles, and when you're out of the market for a long time and the market's going down, eventually it changes. So as we're in a new uptrend, I then start trying to look for a narrative to put on why it's going up. Most important thing is it's going up, but then you find a narrative, not really the other way around. So I thought I'd just quickly try and, have a think about why the market's going up. Because firstly, 5 positives for the market. There's a new uptrend. The UK economy is actually performing better than anticipated. And there's going to be much better economists on this call than me, and I don't pretend to be. The politics and policy, although we're in a general election, the grown-ups are in charge of the economy again. We'll talk about that for a mo. Monetary policy, interest rates forecast to fall, and the monetary medicine has worked on inflation. And then there's the undervaluation key point that we're at a very significant discount. I've got some stats on that to the international peer group. But there's one big negative, which is fund flows. And that's all the small cap funds and so on, because retail investors are allocating away from the UK. Okay, so let's just run through. We've talked about the new uptrend. So the AIM index is at a low, but the FTSE All Share has broken out to a new high, and so is the FTSE 100. So at that same point of the timing indicator, these big indices jumped. So that's great. There's no overhead supply. We're now finally, after sort of years and years and years, seeing new highs on these indices. The UK economy is doing better than expected. Fastest growth in 2 years lifted us out of recession. And the ONS, the Office of National Statistics, showed that they actually revised the pandemic GDP numbers upwards, which actually showed that we weren't necessarily a laggard through that period. So our national narrative is always very negative. But anyway, I wouldn't be surprised if lots of you on this call are going, Ed, the economy's terrible, and I agree, but it's better than expected, I think. The other thing is the grown-ups are back in charge. Now, if my dad's on this call, he'll be going, he says he hates, he once wrote to the Telegraph and said that head boys just do the beak's bidding, and he got published. And he certainly thinks, he'll think these two chaps on the right are head boy types. But the point is that investors and corporates prefer stability and predictability. And I can't tell you how many businesses have hung back from investing in the UK because of the kind of characters we had 5 years ago, which offered a very binary take on high tech, high spending. Well, we got that in both cases, and also nationalism and pandemic chaos and all the more. So anyway, even on the Labour side, we've seen that there's still going to be tough spending rules, there's going to be constrained tax policy and economic stability. Babis, you don't see any grown-ups. I think that's probably very true. Anyway, but what I mean is that they are going to be promising much more stability for the economy. And that's important for investing. It's important for corporates. Monetary policies worked, inflation's down, if you believe the inflation numbers, and interest rates are forecast on the right here to come down over the next couple of years a bit, but don't expect them to get down to 0 to 1%. I looked at 30 years of interest rate history, and I think they've very, very rarely ever been below 4%. We're just in a more normal time now, and I think that's going to last. So we'll see where that leads. But I think this is the key point, and this is using our Stockopedia data. The UK, this is the PE ratio, and the UK is at a 23% discount to Europe. It's a discount to Japan, Europe, Australia, USA, and India in our database. I think the only market that I've got that's cheaper than it is like Hang Seng, and Hong Kong is much loathed at the moment because of all the issues there. But you can see we're at a 23% discount. And of course, our GDP is actually tracking better than, many countries and, Germany and so on. So I don't know if it's justified. And I think there are technical reasons why we're at such a discount. So that is a positive sign. And I think one of the really key points here is that even though funds have been flowing out, people have started to wake up to the fact that there are cheap stocks out there on the market. And the buyers are already coming back, but they're private buyers. They are private equity, they are corporate bidders, and there are record numbers of takeover bids in the UK. We've seen huge amount this quarter of deal volumes, and we've seen last year, we saw so many takeovers. And many people are getting quite annoyed about this because, we all think, well, there's not many companies left on the UK market. But the thing is, it's an indication of radical undervaluation of shares. And they wouldn't be coming in and bidding for these companies if the funds were doing their job. The funds don't have the cash, as we'll see. But there's also a record number of buybacks, which is companies buying their own shares. This chart shows that I think there's a record number of companies actually with more than a 1% buyback program. So the corporates and private equity are buying shares. So there's undervaluation too. And I think, but the one negative sign is in fund flows, but I think this is actually about to change. Retail investors are still not buying the UK stock market. Now, all of you on here are the enlightened ones. I think we've got 650 of you or so who are the enlightened ones who are actually out there looking at the UK stock market. You're acting more like the patient capital corporates. But because there have been 35 consecutive months of selling from retail investors in their ISAs of UK funds, in spite of the fact in ISA season there was the best, like 5 billion was invested in equity funds over the last few years. So anyway, there we are. That can't last forever. 35 consecutive months is astonishing. And of course, what's that done to small caps? What's that done to AIM? It's just driven them down to valuations that really, very few people are taking advantage of. So I think that's really interesting. But that does need to change. And when it does change, it's gonna rock. So anyway, how to find the best value stocks for continued UK stock market recovery. Now, firstly, I've got no crystal ball. As I said, trend follower. If the trend changes, I will change my own narrative as to why the trend is changing. So as long as the trend is positive, and we have had a very bad time for a while, I will be long. And when it goes negative, I will start managing my risk. So I think that's important to state. And I think we all have to be very, very wise to, actually observing reality as it comes. But if we want to find the best value stocks and things do go in a normal environment with grown-ups in charge of the economy and things normalize, how do we find those best stocks? Well, a couple of ways I think you've got to be careful with is broker buy recommendations, and we publish consensus recommendations on stock reports as well. But we did a study, this is a little bit dated, this study, we did a study a few years ago, and we found that strong buy recommendations performed the worst of all the buy recommendations. So we found that sells outperformed buys. And while brokers do, and analysts, and there's a lot of sponsored research out there, which is incredibly helpful. And I'm not dissing the kind of research that goes on, but because it's very, very valuable. You know, there's not enough of it and there needs to be more. But I wouldn't necessarily trust buy recommendations because there can be skewed incentives there and they don't necessarily work. So we're more interested in finding out what methods actually work. And the other thing is just be very careful of story stocks. So I'm sure there's quite a few shareholders of Avacta, and my brother is too. And this company is doing some amazing things in sort of chemotherapy delivery. They've got their precision platform and so on. But I would say, and always give a cautious warning on story stocks, because story stocks often disappoint. And normally they disappoint with some of the reasons that Avacta has disappointed lately, which has been issues of equity, in spite of what somebody called phenomenal results at the end of 2024 in one of their precision tests. So the point is, issues of equity weigh so heavily on investors and on share prices, and the dilution really can hurt. I've got another example here. And by the way, Avacta might get bought out by a big mega pharma company and for multiples of the share price or billions, who knows? But I'm not saying this is going to zero. I'm just saying that story stocks have low odds. This was Sirius Minerals, which was another really great story stock, which was from memory, like potash in Yorkshire, I think the Whitby mine. And I've never seen such a heavily traded stock by private investors that wasn't one of the big cap names. And Sirius Minerals was regularly in Hargreaves Lansdown's top 10 most traded stocks. And I don't know how many private investors in the north of England bought this, but they got into financial troubles. A 400 million bond sale was pulled, the stock collapsed, and then there was a rescue takeover by Anglo American from memory, and at a snip of a price. This is what can happen in story stocks. It happens again and again and again. I could go through dozens of examples from the pandemic. It's quite concerning, and I've got stats on this to prove it. We've been tracking the hit rate of picking story stock winners for a decade. And these stats are taken from a decade of data up to yesterday. And I'm using low ranking shares, which I'll explain in a minute. But on a 2-year basis, only 25% of those stocks actually turn out to be winners. 75% turn out to be losers. The odds are 3 to 1. Which is deeply, deeply concerning. Lawrence, did you just run a poll? 73% of you have been burned by a story stock before. Crikey. Well, that's exactly the odds that I'm saying here right now. And this happens. So how do we spot story stocks? Well, you know if it's a story stock because they do not rank highly for proven factors, which I'm going to explain now. Quality, value, momentum. Story stocks will have very low quality because they don't have any profitability. They're jammed tomorrow. They're normally expensive. And often you don't know they're expensive because often they don't have earnings ratios or sales and that kind of thing. But they are very expensive, and we can show that with our numbers. And anyway, the momentum rank I'll explain, and the overall stock rank is normally quite low. We do have classifications which classify them, but we're not going to do that in this webinar. So look, let's move on and give a stock analysis framework that really works, or I should really frame that and say that has really worked over the last 10 years. And that's our quality, value, momentum framework, which is our stock ranks framework. So this is a quote from Joel Greenblatt, who wrote the brilliant book, The Little Book That Beats the Market. He said, choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. I think that's rather provocative, but the point is we've got to know what we're looking for and what really pays off and why. Now, there's lots of information on all this in the ebook. So a lot of these topics will be in that ebook. So, dig in there for more intel. But I'm going to cover some highlights. So stock market history, Jesse Livermore wrote Reminiscences of a Stock Operator, and it was written about him. But he became known as the Great Bear of Wall Street. But he used to look at the ticker price. It's called a ticker because there was a ticker tape, which actually churned out little loads of paper. And the ticker tape would have prices on it. And whenever the prices jumped through a level, he would buy. He was like the first breakout momentum trader. He understood that strong shares beat weak shares. And he did it in reverse as well. He would short shares that were going down. And in fact, he shorted the market in 1929 and made billions when it crashed. So he became known as the Great Bear of Wall Street. This was the first sort of evidence that this momentum effect worked. Now, Ben Graham, who is now known as the father of value investing, got horribly burnt in that 1929 crash, but then thought about it an awful lot and came up with concepts like margin of safety and buying cheap stocks. And he was really the father of value investing, the idea that buying cheap could outperform buying expensive shares. And one of his students, and he had many because he taught at Columbia Business School, one of his students was called Warren Buffett. And Warren Buffett started as a deep value investor, but eventually, because he was so good at it, he made so much money, he couldn't really find, these small cap value stocks anymore. And his business partner, Charlie Munger, who sadly died recently, convinced him to read Philip Fisher, and they sort of turned him on to the idea of quality, this idea that good, highly profitable shares, you might be willing to pay up more for rather than always looking in the bargain bucket. But these three themes, these colored sort of panels here, quality, value, and momentum, are some of the primary drivers of stock returns. And the problem most people have is don't actually have a measure of them. So what happened is, like the 80s, 90s, computers, databases came along, and then academia started proving that these sort of practical ideas actually had, they could theoretically back them up and also prove them quantitatively too. So Farmer and French proved the value effect and the size effect. These guys, Jagadish and Titman, proved the momentum effect. And more people like Novi Marx proved quality. And there's hundreds and hundreds of academic papers that prove this stuff. And what we try to do with the stock ranks is actually, use and leverage that information and the academia to actually provide good rankings for private investors like myself. And interesting, this is just an outside view. I'll show you some of our data. But at 10,000, this is Farmer and French's data library. And they've been tracking actually all the way back to sort of 1927. But it starts looking ridiculous when you compound portfolios from back then. Because even with this, you've got the momentum portfolio going up 90x since 1990. Now, that seems ridiculous, but actually it's only about a 15% annualized return. But it's amazing how it compounds. The point is that even these sorts of academics have been proving that these factors outperform the S&P, and it's proven all around the world. So anyway, this stuff does really work. Quality, value, momentum, three primary drivers. I know some of you have been around for a long time. You're probably rehearing some of this material, but I've got new subscribers on today, some people thinking about subscribing, and it's great to cover this. And I like reminding myself. So anyway, this is an old stock report of Occidental Petroleum from a couple of years ago, actually. But you can see up in the top right of the stock report, we have these stock ranks shown. So quality, value, momentum. And we rank every stock as a percentile from 0 to 100, where 100 is best. So for quality, you can think of that: good, value, cheap, momentum, strong. So I think of 90 to 100 stocks as good, cheap, and strong, whereas low rank shares on the stock rank as being junk, quality, expensive, or weak. Or story stocks, right? Low rank shares are story stocks. You've got to be careful. The odds are lower the more you go down the scale. Anyway, let's move on. They give an objective measurement of, so if you've got a quality rank of 9, it's got a worse quality than 91% of the market. And if it's got a quality rank of 81, it's got better quality than 81% of the market, which is, I think very, very important to know their percentages. So I'm going to very quickly sweep through value, quality, and momentum. And I think one of the things in this market environment I really want to get across is some points on momentum, because I think we're in an environment where exactly these psychological issues are happening to us right now. So anyway, for value, it's the idea that cheap stocks beat expensive stocks. This is a quote from Ben Graham. Try to buy groups of stocks that meet some simple criterion for being undervalued, regardless of the industry and with very little attention to the individual company. He became something of a systematic investor as he grew older, which I think is really interesting. But that's kind of what we try to do with our value rank. how to measure value. I'm not going to go into all the details here, but everyone will know what a PE ratio is, I'm sure. If you're one of the 650 people in this, after 2 years of bear market, capturing returns, and probably know most of these ratios, like the dividend yield. Now, what we do is we create a composite measure of value against a range of measures which compare the price against what it earns in sales, in earnings, in cash flow, and against what it owns in terms of the book value or the equity value of the company, and the price against what it pays out in dividends. And what we do is quite simple, right? Imagine you've got the whole market ranked 1,000 companies or whatever, 1,500 companies or whatever it is. And we rank the PE ratio and we sort it from low to high. This is some old data, but it illustrates the point. And you do the same for the yield and the other measures like price to sales, price to book, for all those 6 financial ratios. And we turn each of those, just like in a Google sheet, into a percentage ranking. It's quite easy to understand. So the cheapest would be 100 and the most expensive 0. And you bring them all together into, we've got our own special way of doing it, but it brings it into a value rank. So then the very cheapest companies, by the way, not these ones, because I'm just using illustrative data here. And then the cheapest companies will get a rank of 100. So yeah, you can go and look at them at any time. Oops, what have I done? Oh, I'm getting lost in my own slides. There you go. So you'd have that value rank right there. So 69, it's, in the top sort of 2/3 of cheapness, but it's not the extremes. Now, the value rank has a few sort of curious qualities, and you must understand that very, very cheap companies, because this is a pure measure of cheapness, cheap companies can come with financial risks. So in that very cheap bucket, there will be stocks that have dodgy balance sheets, might get financially distressed, and ones that you really wouldn't necessarily want, widows and orphans to buy. But the set as a whole of those cheap stocks, because most people don't like them and avoid those kinds of companies, ends up paying off rather handsomely. So this chart shows you, with 90 to 100 value ranked stocks on the right and very, very expensive shares on the left, you can see cheap stocks really outperform the FTSE All Share at like 8-9% annualized, and the expensive stocks radically underperform. So if you're buying very, very high PE ratios, you might expect to have a bit of a headwind. So I think that's always very interesting. And yes, currency risks, John, you're right. Also, cheap stocks, all kinds of risks in cheap stocks, so beware of them. So I don't suggest people go out and buy a value rank portfolio. This is just a measure of cheapness. That's why you've got to actually look at things like quality. So not looking at value alone, but looking at with things like quality. So quality is the idea that good companies, which are profitable, have good margins, they're stable, and they have cash generation, and they're safe, that they beat junk shares. I'm going to whiz over this because, I'm conscious of time. But the quality rank tries to find good, healthy, safe stocks. And what I mean by good is that they have a good quality of franchise, which is what Warren Buffett would really hope for, like good returns on capital, that's profitability, free cash flow to assets, gross profitability. We also look at margin stability and the sort of, we do a sort of regression on sales growth consistency. So we're looking for good, stable, highly profitable, good margin businesses. But also we weight heavily to see if the financials are improving from last year to this year. And that's an important factor because it helps you find turnarounds. So if a company has actually its financials were a little bit worse last year, but it's made a big jump and it's improved them a lot, that's quite powerful. It's a very leading predictive factor. It's called the Piotrowski F-score, and it's also on stock reports. And we also decrement quality for some bankruptcy risks and also earnings manipulation risk and for leverage. So, we're trying to make sure that it highlights safer stocks. You can get some funny ones in the mix, but we do the same sort of thing. We take all kinds of different financial ratios, bring them all together. We've got our own weighting algorithm, but actually that then helps you come up with a quality rank. Now, once again, the quality rank is on all the stock reports, but we've found, and these are updated performance measures, we've done a huge amount of work to kind of make sure that our database is as accurate as possible in the last 12 months. Thank you to the team who've done an amazing job on this, by the way. Highest quality stocks beat the lowest quality stocks by a country mile. So once again, story stocks will always be in the lowest quality cohorts. The higher quality, more profitable 80 plus ranked shares have tended to outperform. And one of the benefits of that also is you might be able to hold them for longer. And so buy quality, buy reasonably valued. But let's move on to the thing which I think is so important for right now. I've got a great case study that I've used a lot in the past, but right now is a moment where it's even better than usual. So David Stevenson, back in 2013, right? This was actually right when we were launching the stock ranks. And he wrote this piece about us called Stock Screens to Net the Ones That Got Away. And I'm just going to read this out because he says one of his big regrets for 2012 was not having bought into a small UK-based transport group called Dart Group. Lots of quantitative and qualitative measures told him that the owner of the Jet2 airline and the Fowler Welch lorries was way too cheap. Yet sadly, he found more interesting stories to chase, and I let it get away, only to watch in horror as the price more than doubled. So he was obviously thinking about buying it right then, back in September 2012. And then he looked back, and when he was writing the article, he was like, oh my Lord, it's doubled. Well, I'm not buying it now, right? Now, wait, think about the charts of shares right now, because it's sort of beginning of June now. And the market took off in October, November. And so many value shares now look like this, right? So many shares I'm looking at doubled. And I'm thinking, oh, they've gone too far. And what happened after this is quite extraordinary. So pushing this chart forwards from 2013 to 2018, the shares went from £1.50 to £8.50. Now, even over the first 12 months, they almost doubled again. So looking at that chart, you think, oh, I can't possibly buy it. But actually what happens over the next 12 months is that trend continued and continued and continued. And this, I think Jet2, I can't remember what it's at now, £13, £15, something like that. But it became rebranded Jet2 and was one of the biggest multi-baggers of the decade. But that piece has always stuck with me because it really illustrates the behavioral bias we have against shares with, prices that have gone up. And I've seen the discussion on the site, lots of people holding back from buying stocks with good share price trends. So Jesse Livermore once said, prices are never too high to begin buying, nor too low to begin selling, right? Now that's really counterintuitive for value investors. But the point is, if you can find value stocks that actually have rising share prices at new highs, that's a double effect. Now, how do we measure momentum? Our momentum rank isn't just price momentum. So we do look at whether stocks are close to their 52-week highs or above them. We also look at the 1-year relative strength and the 6-month relative strength to see, are the shares beating the market? Are they beating the market now? Are they at new highs? It's really important. I did a great piece on the site. I was really delighted with the response called Trend Clarity. It was about trended momentum. I think we should actually incorporate it into the momentum rank at some point. But we don't only look at price momentum, we look at earnings momentum too. And earnings momentum is the idea that the brokers are having to increase their forecasts and the company is surprising above the forecast. And also they're having to upgrade recommendations, etc. So we factor in earnings momentum as 50% of our momentum score. And once again, you get this amazing chart. The highest momentum ranked shares, strongest momentum shares, outperform dramatically the weakest momentum shares. And this is even more powerful than value and quality, as I'll show you in a minute. And that's why I think finding shares, good value stocks that have moved already, but might move a lot more, is actually kind of one of the best ways to do this. Okay, bring it all together very quickly, quality, value, and momentum. The return drivers are much more powerful together than they are individually. So this, Tina did this great graphic for me. It's really, really, really pretty. Wish I was as good a designer, but no, it's fantastic to have the support. And the stock rank you can think of as a equal weighted composite of the quality rank, value rank, and momentum rank. And really, it's just to reiterate, it will bring together the quality of the company's franchise, the health trend of the fundamentals. It will incorporate safety measures to avoid bankruptcy and earnings risk. Companies will be valued against what they earn, cheap against what they own, cheap against what they pay out, and may have price and earnings momentum. So all of these bubble up into the overall stock rank. And it really is a very, very powerful indicator. If I compare the stock rank, which I call QVM for quality, value, momentum, stocks that are ranked 90 plus, held annually, year by year by year, have returned about 11% annualized, which more than triples your money over a decade. Whereas and have done better than pure momentum, pure value, and pure quality stocks. So actually, quality stocks haven't done as well as value and momentum, but the blend of all three has done the best. And I think it's always so compelling. And the point is, don't just go and find cheap shares. Find cheap shares with good trends that have good quality, and you'll be in a better position if the recovery continues. So I think in finding the best value stocks, you want to be looking with a kind of more blended way. I'll show you this chart on the site. It just shows how 90 to 100 ranked shares have done through time and compares them against these story stocks at the bottom. Mark, yes, you're sharing some dumb sells, and I think plenty of people can relate to that. It's something that we all suffer from. But as Peter Lynch said, and I love this quote, in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. Then most good stock pickers are only right about 6 times out of 10. And I'm saying that because I'm going to share the statistics of the hit rates, right? The stock ranks, these are the hit rates, and the 90 to 100 ranked shares are on the right, and the 0 to 10 ranked shares are on the left. And you can see that 90 to 100 shares, actually held for 2 years here, have a 63% hit rate of being winners. Winning is in blue. In other words, they've had a capital return that's positive, whereas 37% have been negative, have losers. So the hit rate is only about 6.5 out of 10. Okay, whereas at the other extreme, it's 3 to 1 against. The hit rate of winners is very, very low. I think on an annually rebalanced basis, this is about 58%, but slightly higher for longer holding periods. Most people I know actually do hold for longer than a year, even though I'd say a year is a kind of optimal holding period. But this is really important because it shows that higher ranked shares improve your hit rate. There we go. And anyways, and this excludes dividends as well, by the way. So just to reiterate on that point, this is just showing you that there's a 63% chance of picking a winner in a 90 to 100 stock rank stock. And there is a 37% chance of losers. And this shows the distribution. So you can see, like, there's only going to be a few percent of stocks which ever double or more. I've slightly cut off the edge of these charts, but it just shows the general theme. So there are a few percent, what is that, 5-6% that will lose 50%. So you have to be careful, and you always have to have risk management, but it just reiterates that theme. And for very low ranked 0 to 20 stocks, once again, just again showing you that. But one key point here is that in these low ranked shares, you will find that occasionally you find ones that double and triple at a higher rate than even high stock rank shares. Problem is, your odds of finding them are so low. So it's kind of like they're priced like lottery tickets. And so they're always priced expensively. Lottery tickets are always expensive. But anyway, there we go. Now, I'm going to quickly just show you some points about high ranked shares, because I think it also gives some insights into broker recommendations and price targets and not being swung by them. So I showed you this chart for Avacta, which showed, and Avacta has been ranked as a sucker stock on a stock rank of 1, and it's had a terrible sort of trend down. And whereas McBride, and interestingly, McBride's in green and Avacta's logo is red. Anyway, McBride has been, which, issues out sort of own brand, sort of cleaning products and things for supermarkets and things. They keep coming out with ahead of expectations announcements, and, classic chart, a bit like we saw with, the dark groups of this world. 99 ranked super stock, but always ahead of expectations. Avacta always issuing equity. So I want to explain that these are not just point cases. These are actually general themes. So once again, we've got the rank on the x-axis, but this time I've got profitability on the y. Return on capital, return on assets, the 0 line here. High rank shares are very profitable. Low rank shares are very unprofitable. Okay, so high rank shares very profitable. High rank shares also growing. Now, I've averaged this data over 10 years of market history. So this is not as of today. This is as of on average over the last decade. So high rank shares on average are growing faster than low rank shares. So they're profitable, they're growing. So surely they should be expensive. But the most profitable, most highest growing shares seem to be on the lowest PE ratios in blue. So the lowest PE ratios for the highest profitability, fastest growing shares doesn't make sense. The price to free cash flow, the price to earnings ratio are really, really high for low ranked shares. That's crazy, right? So brokers must love profitable, growing and cheap stocks, surely. But this chart shows the upside to the broker price target is highest for low ranked shares, and their forecast growth is really high for them too. But they've got really low expectations on these shares. It never makes sense to me, which is why great businesses with low expectations, they keep surprising to the upside. So McBride keeps surprising to the upside, whereas the Avactas of the world keep surprising to the downside and then needing more money. And that's why they end up having loads of dilution. So low ranked shares dilute their shareholders by 15% plus annualized. So if you've ever been hit by a placing, and do say if you've been hit by unexpected placings in the chat, because they happen so much in low ranked shares. The dilution in high ranked shares is very, very small. Not to say it doesn't happen, because profit warnings happen, companies need to raise finance, etc. These high ranked shares, these are averages, and they're not immune to placings and things, but it's important to know. Anyway, why are high ranked shares so underpriced? So why are they like this? My theory is that it's all behavioral, that investors avoid good quality stocks because they're quite unexciting. McBride doesn't seem exciting. Avacta seems exciting. Investors also avoid value stocks as they often seem to have problems, whereas they like glamour stocks because they seem like they've got great fun news flow coming. But investors also avoid momentum stocks because of those scary high prices. All those charts you're looking at where all these value stocks have gone straight up, it's really hard to do, so they're underpriced. That's really important. Now, I'm just going to give some case studies of applying some of these principles in portfolios. The one thing I would say about those distribution charts is, like, my point is not that everybody should just go and buy high ranked shares. My point is that you can find great winners in low ranked shares, but that's where you need to do much, much more research. So you don't have a tailwind behind you when you're looking further down the rankings. That's where actually you as a private investor with lots of time can actually get the edge. And I'll show you how Paul and Graham have got the edge this year. So the NAPS portfolio is a portfolio I've been publishing now for 9.5 years. And it's based entirely as a 20 stock portfolio on the highest ranked shares from the 10 sectors we published. And I just publish it once a year. So, and it's returned just in capital returns, 13.6% annualized, which I'm very, very pleased with, in spite of these dismal 2-year periods where it underperforms horribly. It does underperform because of bear market, and it has some exposure to small caps, but a 235% return. And this year it owns Greencore, Reynolds, Seplat Energy as the 3 highest performers. And that's a very, very simple mechanical approach. I saw Mark Carter here. He has run a mechanical approach for a long time too. And it really does and can work. This is actually a personal portfolio I'm going to share now. And because I wanted to just explain how I use some of those timing signals. This is a new family portfolio begun in May 2022. And it's being run 2/3 systematic and 1/3 discretionary. And it used the AIM market timing for entry. Okay, it's about 25 stocks, been running for 2 years. And very, very interestingly, because of the market being in a bearish period, I kept it out of the market mostly. And it's had certain injections of capital at different times. But I kept it out of the market for quite a long time. And it's really hard to do when the market seems to be going up, but your market timing signals are still negative. So I put 1/3 of it invested in a portfolio in January 2023. And that was a market timing signal that failed. Was pre-committed that it would stay invested, that proportion would be stay invested, and we would invest again on the next signal breakout, which was in November, and we invested the rest of the money then. And interestingly, from that set of investments, U Group and Kitwave were both selected, and U Group is still owned. It's up 200%, it's tripled. Kitwave has almost doubled, etc. And the rest of the portfolio invested here. And so it's been it's been great to see these things actually working. And because we've got quite a high weight to AIM stocks, Well, although I can't in my portfolio system, I can't track the AIM index annoyingly, because that's really kind of more of a benchmark. But that's down 18%, whereas the portfolio is up 23%. So I'm quite pleased with the results here, because I've got family beneficiaries of this portfolio, and it's good to see. And finally, yes, I do use the 120-day Paul. Paul, I thought you might be coming. I saw that you'd mentioned this on the SCVR. Now you'll be happy to see this slide then, Paul Scott. So the small cap report, which I'll demo in a moment, which how to get around the site. But Paul and Graham, who write the small cap report, and Roland helps them quite regularly at the beginning of the year, and they link to a sheet with a bunch of stocks to watch. We don't recommend any shares on the Stockopedia site. We never say buy. And as I said, we're not a financial advisor. Everyone's self-directed. But Paul and Graham obviously are analyzing the shares every day throughout the year. And they put 30 undervalued stocks on a couple of lists. I think Paul had 20 and Graham had 10. And I think actually it's 29 stocks, because they both had CMC markets on their list. And interesting, they both had CMC, and that's almost tripled. So quite an amazing result. And that watch list is up 24% year to date. And the NAPS is up 15%. And I think this is a really interesting point here. And what I would say is, like, if you are a stock picker, if you aren't a stock picker and don't have time, and I learn all the time from myself that I try and be systematic most of the time, but I've got my own stock picking portfolio. And normally when I pick my own stocks, I underperform my model. So it always retrains me to only invest systematically. But there are great stock pickers out there. And the point is, if you're doing the research, you can then find great opportunities down the rankings. So interestingly, the average stock rank of their watch list was about 70. And I actually put them on this chart to show the stock rank at the start of the year and the price change year to date. And you can see that's probably CMC. There's been some couple of big winners here and here. That's probably Reynolds. Not sure what that one is. Anyway, you can see above an 80 rank, that hasn't been a loser. Above a 75, hasn't been a loser. There's been a few losers in lower ranks, but also there's kind of a broader distribution. But you can see there's still a skew towards those high ones. And I think when there's a bit more conviction on lower ranking shares, they got into the list. And I think that's showing that this is kind of the way everybody, if you are a stock picker, should use the rankings. I always say that, like, if you don't have a weight towards higher ranking shares in your portfolio, and your portfolio is the other way skewed, you will be fighting a headwind, okay? Because what tends to happen is large diversified portfolios will tend towards the average returns of the average rankings. It's just like, that's the way the maths works. So anyway, nonetheless, amazing stock picking returns in those watch lists. So I'm now going to do a quick demo. I'm conscious I've done 47 minutes, crikey. I'm going to do a quick demo of just some key things on the site. I do have some notes somewhere, so I remind myself. So obviously, for any share that you have, you can just search. So let's look at Games Workshop, one of the great stock market winners. And Games Workshop, I hope you can all see this. I'll zoom in a little bit. Games Workshop, I think I have a look over a 10-year view. It was one of the highest ranked shares before it took off. And again, you should look at our multi-baggers research, because it was terrific. The webinar, I learned so much doing it, and I recommend you go and review that in our academy. But anyway, this stock absolutely flew with all those ahead of expectations, like I mentioned, these great stocks have. And the stock rank then came down because it got higher and higher valued. It was valued on a P of about 50 at this time, and hasn't really gone anywhere since. But you see this revaluation, and the stocks kept growing. And then, it fell a bit, but it sort of consolidated. That was the bear market. But I think it's really fascinating. You see the ranks up here, super high quality company, just on a premium valuation. It's on a higher P ratio and other metrics, but a brilliant company. I know lots of people own it, and long-term buyers. Reynolds, and full disclosure, I do own this stock, one of the big winners in this year. And again, a 99 rank. I was watching this for quite a while. Paul was mentioning in his small cap reports. I saw someone pitch it at one of those Mellow conferences as well. And I bought it for my stock picking ISA about here, and have had a very quick 80-90% return. So very happy with that. And you can see high rank, quality, value, and momentum. And there is a big pension deficit. They're sort of paying it off. And anyway, I'm not the expert. Talk to Paul and Graham about that. So anyway, that's kind of the way that you would look at those sorts of shares. Just you always use this chart. I think is really fantastic. Those are the two kind of stock rank features, but also this style classification. I'm not going to cover them in this, but there's lots of information on that in the ebook that we'll give you in a moment. Anyway, now if you want to go and look at the performance charts, at the moment they're in Learn, Stock Ranks and Ratings. Okay, and you can go and dig around here and see the difference between how 90 to 100 ranked shares have done against their opposite. So it's all kind of valuable stuff. Now, what I would say is if you do find shares that you're interested in, however you come across them, all right, let's say you are looking at like a stock like Reynolds, and you've got this add to folio button, and you stick it in here. Hang on, let's get rid of that. Click add, and it will be in your watch list. So you can then go and have it saved in the list. I should have really prepped a bunch of shares for that, but I'm just going to show you a couple of views. Okie doke. Well, yeah, a big Healy. I'll have a look at that in a minute. We'll do some Q&A later. So anyway, you get loads of table views, and those table views are obviously packed with information, and you can customize these as you wish. So on a typical watch list, it's mostly quotes, and there's a rank here, but you can customize this with any of hundreds of different financial ratios. So you can add different fields, you can add P ratios and all kinds of things. But obviously, if you just want to add, for example, the quality rank, you can also search, add it as a column, move it around wherever you want it, apply the changes, and you've got it bang there. That should, unless I'm having like a live issue, I think it's because I've got a massive watch list. It seems to be hanging for me. Don't know why, but anyway, that's what you do. Is my connection okay? No, might be my internet connection, but anyway, there you go. But the point is you can customize those. We've also got ranks in a custom table view right here. So you can see the quality, value, momentum rank, and the stock rank. I actually customized this table earlier to add a growth rank, which is another one. It's not part of the stock rank. It's not as predictive, but some people like it. So I added it into this table view, and very, very easy to remove these things if you don't want them to. So for example, just hit remove that column, apply the changes, and away you go. So anyway, that's kind of the way it works. And well, a couple of other things you can do are you can look at the tables, but also there's this rather fabulous bubble chart view. I don't really have time to look at it, but I would suggest you go and have a look at it in your own time. So how do you go and discover shares, right? Okay, well, there's two ways, and it depends on how you like getting your ideas. If you're someone that likes reading research and community insights, two things I'd look at. Firstly, editorial, and also this great widget on the homepage called Most Viewed in the Community. Now, I was looking at this and earlier today, and I saw that N Brown was up 33%. And I know that N Brown is a deep value stock, and that deep value stock is now gone up 33%. So this is a good way of figuring out, well, what's kind of moving and people are really looking at them, and you can click through and review them. But obviously, a lot of people are interested in the research and the community and the sort of scuttlebutt that comes out on a daily basis. And the sort of small cap team actually look at a lot of different types of shares, and there's a great community. And as you see, 126 likes on this. And thank you for promoting this webinar tonight. And glad we're mutually reinforcing each other here. And on this page, you can also find some of these watch list ideas. And the guys go through a range of different stocks that have reported in the day and react to the news and discuss all the details of it. And I don't pretend to have anywhere near the kind of knowledge that these guys do, but it's amazing. But you can, in the sidebar, review the stock ranks for any shares that have been mentioned. So I spotted Ramsden's Holdings. I used to own this, stock rank of 80, and you can click through to the stock report and so on, add them to a portfolio if you want. So I can add it to the webinar portfolio and just click add, etc. So quite useful. Now, the other way I like to find shares on the Today page is to go and scroll down a bit further and see this stock rank movers widget. And this made me spot that Reach PLC has just gone back up to a 90 plus rank. So I'm going to click through there. That widget shows you anything that's moved from below 90 to above 90. And quite interesting because I used to own this and I actually four-bagged this in the pandemic when it moved through 90 before. Very speculative share. It's owns all the Trinity Mirror newspapers and things like that. But I thought it was quite interesting. It has had what probably one well-known private investor would call maybe a bowl. But anyway, this thing kind of goes up and down an awful lot. Yeah, Ian, as you say, the SCVR is worth the subscription on its own. So anyway, I will do that sort of thing. The other thing I will do is look at the stock ranks lists. So the way to do that is to go to browse. And I'm just going to pin this for the time being, because in this sidebar, you'll see sectors. You can go to the sectors, basic materials, consumer cyclicals, or even down in industry groups. You can go to the aerospace and defense sector if you like, or industry group, and you'll find, well, Rolls-Royce has been an amazing winner, high rank share, it's got a great trend, it's done very well. So that's a way that you can go and look at different sectors and find high ranking shares in sectors. But we've also got these Stockopedia screens, which are either under popular screens or top stock ranks, and you can go in there and go and browse lists of top momentum or top stock ranks shares. So let's look at the QVM ones. And you can see this is actually a different sort of tracking. This is a 25 stock portfolio tracked over time and rebalanced very regularly. This shows that Sarabi Gold is the highest ranked share in the market. At the moment, gold, there's a few gold stocks ranking rather highly, with the gold price going out to new highs. So very interesting. But you can also create your own custom screens. So I do recommend you go and dig around in all those lists. They're a great source of new ideas. But you can, of course, go and create your own screens. So if I click over screens, new screen, by default, it's sorted by stock rank descending. And you can see, again, Sarabi Gold at the top. But let's say I wanted to change that to be some other rank. It's quite easy to do. I click that, change it. Could be the P ratio, could be something else. But I can very quickly add a rule. So if I want to find yielding stocks, okay, very easy to do, add a rule, and greater than 3% yield. And I've suddenly found, 351 stocks instead of 1,400 stocks in the market. I can then, exclude small cap shares if I want, add the rule and make the market cap greater than 50. And then we can add, for example, a quality rank. So if I'm looking to have a kind of an income portfolio of high quality yielding stocks, it's that easy to find them. And then you can sort of go and dig around and do your research, et cetera, et cetera. So it's quite very powerful, this system. I'm really proud of it. So that's most of the things I wanted to cover. So that's a very lightning tool. Do we track the rate at which a stock rank goes up or down? Not at the moment. It's actually, I really want to research this next, is what happens to the performance of a share when it jumps in stock rank. So anyway, leave that with us. But I want to go back to my slides because I did promise to find there was something on the landing page. It's like the top 10 value stocks for the UK market recovery. Now I've only done this from my perspective, and I want to show you that the top 10 good, cheap, strong stocks now. We're on 58 minutes. So the first thing I want to show you is how have the top 10 stocks held annually since start of 2015 performed, okay? Because I really don't like doing things like this, and I want to make it clear these are not recommendations to buy. What I've done is compiled this from the data from the QVM that I showed you earlier, right? So one stock from each sector held annually, it's a very volatile ride, right? And I know in this 2017, this extraordinary jump where the portfolio doubled or more, actually was very driven by Games Workshop and probably IQE. So you actually have seen that over 5 years, this portfolio, if it was a portfolio, would have gone nowhere. So I don't really recommend just owning 10 stocks. And what I've done is I've overlaid 20 stocks with the same rules, so 2 from each sector, to show the difference. So they own 20 stock portfolio owns pretty much half the same shares, but you get this smoother ride. And but anyway, the volatility of like a very concentrated portfolio is very galling. But I thought what I'd do is I'd share. And actually, Paul Scott being on this, Paul, if you've got any insights into these shares, you might want to kind of just go and put in the chat. No, that one's a terrible one, Ed. So anyway, these are the top ranked shares when I put the slides together a couple of days ago across each of the 10 sectors that we have. And these are primary listed shares, not dual listed shares in each of 10 sectors. So, and I own some of these. And but firstly, in basic materials or mining is Sarabi Gold. And if you do, by the way, if you do own any of these shares, do just add in the chat, mention your thoughts on those shares, any in this list. And Lawrence will send them out. And obviously you can go and my point is I'm trying to help empower people to find these sorts of stocks themselves. Reynolds is the top ranked share in industrials. I am long Reynolds. And it's already, as I said, it's already had a lot of share price momentum. It's probably making quite a lot of people uneasy. And in fact, quite a few of these shares are because they've all got a momentum rank loading. So McBride being another one in consumer defenses. It's had a really good run. Smith's News. I think Paul recently mentioned that he didn't think this one should ever justify a P of above 10. And Smith's News, they I think spun out from WH Smith and they sort of deliver all those news all the kind of newspapers and so on. And it's not like these are not glamour shares, right? When I remember I say we all have a sort of natural aversion to a lot of these shares. Oh crikey, just hurt myself. And we have a natural aversion to buying these sorts of shares. So just be mindful of that. And TP ICAP's a big into broker dealer, which is apparently has got a worth a lot more on a sum of the parts basis. Worth going and having a dig around for that. I think that one might have been in Graham's watch list. Somebody's saying McBride. Yes, Paul saying likes Reynolds, Smith's News, McBride, stunning turnaround. Gulf Marine Services. Now, this was flagged years ago. Can't remember who it was at one of the mellows, and it's quadrupled since then, I think. So, again, another value share that's gone up a lot. GMS. I would say, like, if you remember, this is a sort of oil services company. And there are a lot of oil and energy stocks which are high ranked, if one's looking for oil and gas exposure, not just services companies. So be mindful of that. A lot of people don't like owning those sorts of stocks because they're into ESG. But anyway, like I sometimes say, that you do find sin stocks on the top of the ranking lists. OPG Power Ventures. I do actually have an interest in this, but this is an Indian power company. I found there are no SEVRs on OPG at all. In fact, I think 3 out of 4 of these last stocks have got some foreign interest, which makes me rather nervous. And MTI Wireless Edge, I think Paul's mentioned at one time, good balance sheet, lots of dividends, but a lot of foreign ownership. GlaxoSmithKline will all know, GSK, big healthcare stock. And Airtel Africa is the highest ranked telecom, but only at 79. And I think this is the important point that I would say is that, thank you, Simon. Reynolds has justified my subscription several times over. You do tend to find that. That will happen again and again and again. I love the community here. I love what we do. Still so excited about what we do and actually what we can do in future. So anyway, I think this is a really interesting list. I am hugely averse to lots of these shares. I've got psychological biases against so many of them. And I'm just always stunned by, you look at the kind of record of these things over the long term. Now, the thing is, if the market does correct, one thing I would say, if the market does correct, you can see the behavior of these sorts of stocks can sometimes correct with them. Some of these are small, there's 2 micro caps, there's a range of mid caps, a couple of large caps. So be very, very careful in these sorts of shares. There are some speculative shares. None of them are highly speculative, but the risk ratings do show that some of them are speculative. But the point I would make is, like, when you're looking at charts, it always looks like, they've gone up so much. But if they were to continue going, then this sort of thing here could end up looking like that patch there. So, I think that's always quite interesting. One has to sort of trick oneself into behaving differently. But anyway, that's kind of all I've got for today. Now, there is this ebook gone on for an hour. There are 100 pages, 160 pages, all about the stock ranks. There's a bunch of context in there. Please do check it out. I'm going to go into Q&A now, but there's lots of information. Do give at least some of it a read, make it worth my while in writing it. And I think you'll find a lot of useful insights in there. Some of the more practical things are later on, and there's a bit of theory at the front and that kind of thing. So please do check it out. Now I'm going to go and I'm going to have a look at what questions you got for me, because we're going to do a little bit of Q&A and use the site. So let me start and have a little look. Well, hopefully the presentation will be ready. I'm not sure whether Lawrence will be sending it out today or now, or even through the interface here. I'm not sure. And I think he's saying by tomorrow. So where is BAE Systems heading to? Oh, crikey. I mean, all I know is that all these defense companies have been on a bit of a tear because, you know, there's so much more defense spending. I've let some little businesses get away from me. So, and you know, it's deeply annoying. But you know, this is what happens. They start kind of moving these shares, and it's quite frustrating. But so I'm not going to. No, I'm not going to give a view on where stocks go. I like investing in averages. How do we calculate the quality score? It's all in the ebook. So if you've got lots of questions about the ranks, you will find lots of information in the ebook. So for example, there's a whole chapter on quality and gives you lots of information about it, how you can measure it, our quality rank, the metrics in it, performance of it, guide to it, all that stuff. So it's pretty cool. Right. What about the likes of NVIDIA, whose value's in the toilet? Its quality is good, but the momentum is high. I mean, I was looking at NVIDIA the other day, and I was quite pleased to see at one point, quite a while ago, it had a rank of 99. So, you know, right back here, I think it was one of the kind of top ranked shares in the US market. And unfortunately, I wasn't looking at the US back then, but we do, and it's absolutely flown. And, you know, for our sins, it had a very low ranking right at the bottom after that correction. But again, from that point when it went 75 plus, it's done rather well. Now, an expensive share like this has got a fingerprint of a high QM share, quality and momentum. It's a high flyer. Never bet against high flyers. Okay, high flyers. Actually, in the ebook, I show, and actually, I might just jump to this. If I was to show you, I believe I've got some slides on this. The high flyers are amongst the highest performing shares. So high flyers, I don't know if you can just see that. Yeah, he's sharing the ebook now, but on page 100, you can see high flyers have done rather well. So don't bet against high flyers. So the valuation, I mean, look, I think this is overextended? Yes, I think it's probably gone too far. There will be a huge amount of competition that comes in at some point. I've been through market cycles like the dot-com era, where I've also seen, you know, companies like Cisco, who were, you know, they always say in a gold rush, you want to sell the shovels, right? In the internet gold rush, Cisco sold the shovels. In the AI gold rush, NVIDIA's selling the shovels. So they're going to make out like bandits for a long time, and it could well still be undervalued. Eventually, there will be more people selling the exact same shovels, but when that happens, I have no idea. So anyway, just be aware of that. So anyway, I'm not going to predict where it's going. I'm a contrarian investor. How do we balance low momentum? There is a really good insight in the ebook, actually, about contrarian stocks. I'm hopeful you can see this chart, but contrarian stocks and holding periods, contrarian stocks need long holding periods. Do read page 100 and 101. Contrarian stocks tend to be poor performers over a 1 year basis. They're like good quality stocks that have bad momentum. And I can go and find a few of them here. And generally we find that they perform well if held for like a couple of years. But the problem is, and don't look at this chart, ignore this chart because it's rebalanced quarterly. And the payoff to quality and value is actually holding for like a year or two. So, and you can see like, okay, there's Card Factory as an example, which has been quite a popular share for private investors. And, but it's kind of like corrected a bit. It's good, it's cheap, but the momentum's not with it. So Shoe Zone, Good Energy. I know it was in the NAPS portfolio. It's corrected. And, you know, sometimes you've got to hold these things for longer. So how do I define winners in those cases? It was literally in the slides. Winners are just shares who have had a positive capital return. All right. So that's the important point. They just had a positive capital return. So that's the only way I define winners. Okay, this is a good question. What is the reasoning for 1 year as an optimal holding period? I probably should have put more on this in the ebook. Generally, you find that value stocks, like I was showing, tend to benefit from longer holding periods. So we actually found in the styles classification that contrarian shares and turnaround shares benefit from longer holding periods, so more like a year or two, whereas super stocks, which have got more of a QVM loading, actually do best over a 6 or 1 month holding period. But I would never encourage anybody to trade quarterly or semi-annually, because the trading costs just eat you up. You've got transaction costs. And I find that for most styles of shares, the holding period of about a year works okay. So momentum tends to tail off after a year, whereas value benefits from longer than a year holding periods, and quality too. So I find that a kind of around a 1 year, 18-month holding period is a sweet spot. If you're proactive and are looking for kind of the, best returns. Of course, if you really love your companies and you are trying to compound them over the longer term, just understand that the biggest multi-baggers, in our study on multi-baggers, I can't find the slide, wherever it is. Am I going to find it? Oh yeah, here it is. The biggest multi-baggers were best held over kind of like 10 years, but they kept their quality really high and the value rank fell through time. So, companies like Games Workshop, you don't want to sell those after a year. So if the quality is sustained high and you're quite happy with how the company's developing and it's on a growth track, do keep holding. Why do I think the positive negative split of high rank shares isn't better than 63 to 37? I mean, like I said, I fundamentally believe that you're not going to find ranking systems. And if you can find one that does better than in the UK market in the last 10 years, that does better than a kind of 6.5 out of 10 hit rate, you should bite someone's hand off. You might find technical strategies that are more timing oriented, or even mean reversion strategies that have a better hit rate than that. But the point is, there's actually two things. There's one is the hit rate, and then there's what's called the slugging ratio. Slugging ratio is actually when you have is how much profit you make per winning trade. And the point here is actually that you might get 6 out of 10 winners, but those winners, if you get some of them that are doublers or triplers, they drive a huge amount of the return. And I've seen that in the NATs every year. You're even seeing it in Paul and Graham's watch list this year, that CMC Markets has gone up 160%. And that's pulled the whole set. There was a great blog, I wish I had the link, written by a complete outsider on Substack. Paul, if you've got the link, do share it with the viewers, because I think it's really interesting. Do you have any? Yeah, of course. Examples where Stock Screener gets it really wrong. Oh my lord. I think DX Group. No, that's been taken out. I've got a little hack, by the way. If you want to find, now I say this probably won't work. I think it's called DX. Am I going to be able to find DX? You can actually find delisted shares by searching for them. So here's DX Group, which was a delisted share. You can't find it from the top search, but you can add them to your portfolios. From memory, I haven't prepared this, so probably, I don't know if we'll have all the data. Sometimes on delisted stocks, it doesn't render properly. Yeah, here we go. Yeah, this is a very frustrating one. So this had this was the one stock I remember which had the biggest fall ever. And it was a high rank share. It was a 99 rank share. And then suddenly it fell 65% on the day on a profit warning. Okay. It does happen. All right. And that's, we didn't change anything in our algorithm. In fact, I wrote a little bit in the ebook on this. And it's just something that happens every now and then. And it's really, really frustrating. But profit warnings happen. And profit warnings are going to happen to more profitable shares, right? You're going to see profit warnings in high rank shares. You're going to see placings and emergency fundraisings in low rank shares. So, just be mindful of this. It does happen. Lots of good. Is there any correlation with ranking and takeovers? I know Keelan wants to do a research study on takeovers, so I can't answer that yet. Of the 70 to 80 stock rank on the last slides, how many had their stock rank lowered due to one particular QVM factor specifically? I can't answer that question at the moment. It's a good question. When's it best to dump a bad stock? Look, I would say in Learn, if you go on the homepage, we've got lots of cool studies here, and we'll get the stock ranks one in. But all these click through to this academy, which is quite a valuable resource. So I'm pretty sure, I hope we've got something on profit warnings on here. Let me just see. Yeah, the Profit Warning Survival Guide. This is based on a lot of like Paul and Graham's small cap work. And this is a fantastic study that we did years ago, which shows that profit warnings are, you're best to sell on a profit warning unless it's a really high quality stock. So we've got lots of really cool statistics in there. We did this a long time ago, and I think there's some terrific data in there. So do check it out. But generally, we've got this anatomy of a profit warning. And sorry, I'm not going to be able to show you this very well. But when something goes wrong, the statistics say sell on the first day of the profit warning. You've lost money over the next kind of year or 18 months. The average shares are going to still be at a lower level. The only stocks which actually behave differently were high quality stocks. But I won't find it now, but that's an important point. So check that out. Let me see. Have they worked better for some sectors rather than others? Again, look in the ebook. Yes, it's true. They have. I've got some really good stats on that in the ebook. I'll see if I can find it. Yeah, there you go. So, for example, energy sector, you can see in this chart, healthcare, basic materials, technology, they've done particularly well. There's some sectors like telecoms and energy sector they haven't done as well. But that's partly because of the way those sectors have behaved. So check it out in the ebook. And what's the best way to look for earnings upgrades? Well, you can screen on earnings surprise. And the best way to look for them is to read the daily commentary, I think. That's key. And so what else have I got here? Q&As. I'm just going to whiz through. What's a top QVGM rank? Good question. Again, it's in the ebook. It's quality, value, growth, and momentum. We've always published that. Some people like that. There's a whole guide at the back, very back, which explains each of the composite rankings. So it says, for legacy reasons, we also keep the QVGM approach. I think there was a research paper we studied once, and from one of the institutional banks that use a growth factor in their overall composite, but we found it hasn't performed as well as the QVM, and we dropped it. Looking at some of this, how well do the stock ranks work with US shares? So that's a really good one, and don't hide from this question. I'll show you actually, and if you go and Learn, now this is a really important point, and I again address it in the ebook. Hopefully this won't take too long to compute, but you can see the blue line here, which is the S&P 500, has beaten all the stock rank deciles, which people don't understand, right? And the reason why is because the S&P 500 in blue is market cap weighted. All of our tracking is equal cap weighted, which means the median stock in America would probably have only returned 36% or 50% over the last 10 years. Whereas the S&P's returned 175%. Now that's weird, and trust me, that's pretty much a fact. And but interestingly, if you look from the bottom of the COVID crash, you start seeing that the average stock started outperforming significantly. So why that is that I believe that the value effect is coming back, and in a higher rate interest environment, you're starting to see the average stock outperform. Now, the S&P has got huge concentration in the Mag 7, but this is the one region in the world where market cap weighted indices have outperformed our highest ranked shares. And, if people look backwards, they might go, oh, well, I'll just buy an index tracker. One thing to be mindful of is you're going to find people like Warren Buffett have been selling Apple. Okay, why? Because it's on a P ratio of 28. When he was buying it, here's another tip and trick. He was buying it in 2016. Okay, I'm going to show you what the stock report of Apple looked like when Warren Buffett was buying it. I think it was around February 2016 that he disclosed he was buying it, February, March, I can't remember. And back then, Apple was on a P ratio of 10. The stock rank was 86, right? And he was buying it on a correction, and it was on a P ratio of 10, okay? Now it's on a PE ratio of 28 times. Okay, so it's nearly triple the valuation. He's selling it now. Now the S&P 500 is loaded with these stocks, and that makes me a bit uneasy. And I think if the one risk for the UK market is the S&P collapsing, but so anyway, quite important. Now I've answered that question. Crikey, lots of good questions. Have the individual QVM ratings changed since inception? No, we've really focused on data quality. I have got a range of things I'd like to do to improve the rankings, so we might well update them at some point. And in fact, it's getting closer to that date. And so anyway, yeah, Charles Ritchie, the principles do apply to US stocks, and I have found they've worked very effectively in US stocks. And I think I've probably got through to most of the questions now. So anyway, like I said, look, if you are a subscriber, thank you. Just actually, there's a couple of things I can probably say right at the end of the presentation, just for one last thing. Some people say when to sell, and it's in the ebook. There's this great paper on it saying optimal buy and sell. It's best to buy around 90 plus and sell around 70, 75. So that's useful for people who want a rule of thumb on using the rankings. And then I would just say, other resources, there'll be a few more in the slide deck. But if you are thinking of subscribing, please do check out the site. Thank you all so much for joining today. It's been brilliant to have lots of you on here. 500 of you, even when the sun's out, you're probably all having barbecues. It's time to go and get some supper. And thanks very much for joining. Do have a good dig in and read the ebook. And let me know your thoughts. If you find a typo, find an error, something you want to know more of, or you think I've probably got in the wrong place. It's really hard editing and structuring an ebook like that. And please do let me know, because there will be second editions and so on. And that's all, I think. So thanks for everybody. I will speak to you all. Yeah. Thanks, Charles. Excellent. And thanks for dropping in, Paul. And anyway, good to see you all. Take care.